Hi, welcome to another episode of the Investor's Guide to Hard Money Lending, brought to you by CoreLend Financial. My name is Alissa Fowler, and today we have Ryan Guest with Northpointe Bank here with us. Thanks for joining us, Ryan.
Thanks for having me.
So, we've known each other for, I think almost a decade now.
Yeah.
As soon as I got into real estate, and you're now with Northpointe Bank. Can you tell a little bit about what you're doing over there?
All right. So one of the great things about, and I won't mention anywhere else I was prior to, because I don't like to talk negative about anybody, but I had an opportunity to go to work for a great institution, which is Northpointe Bank. They're out of Grand Rapids, Michigan. And they just, their focus as a banking institution is really, they're all about mortgages. And, a lot of times banks have trust aspects and, just all these different aspects to a bank, right? SBA loans, this, that, and another. Their sole focus is truly on mortgages that I'm aware of, unless there's like hidden departments or anything like that. But, going to work for an entity that is built out that way and having the people in the places that they need to be in order to watch growth happen and be extremely pro-growth is nothing short of amazing. Honestly, 30% of what the bank did mortgages last year was non-QM. And for a lot of people out there that may be watching, what is non-QM?
What is non-QM?
Right, non-qualifying mortgage. So basically anything that falls outside of the umbrella of Fannie and Freddie. Okay. And for a bank to be doing 30%, almost basically 1/3, and I think it will be growing to 1/3 this year. That's unheard of for a bank to do that. So,
and that's what a lot of our borrowers are going to be going into is non-qualifying mortgages.
Yeah, very, very few people, unless and sometimes it does make sense. If the person has owned it for a long enough period of time, maybe it does make sense to go into a Fannie or Freddie, conventional refinance. But I've seen with where interest rates are, that probably about 95% of the time it makes sense to go to mainly a DSCR loan. Right.
Yes. And that is what most of our borrowers are looking for. And that keeps growing. And especially in the real estate market that we're in right now, I know we're seeing it at CoreLend where, yes, we fund fix and flips too, but where it has been, and then it got to be, we didn't see as many big fix and flips. We'd see turnkey flips. Now we're in the probably 75% of our deals coming in are the bridge loans, the BRRRR strategy, where they are going, their exit strategy is to refinance into a DSCR loan. Right.
Now that's probably the hottest loan on the market. Like if you had to have a top 10, that's probably the hottest thing going right now for sure.
And they are, and it's for people, they may have thought they were going to sell it as a turnkey flip, but the market's just not there as much as it has been in the past. So let's figure out how to wait it out. It's cash flowing and we're doing it. So, on what are you looking at? Because I know this will be an interesting thing because we've had a lot of our borrowers, they've maybe taken a little past their 6-month mark. They're taking a little longer to get refinanced. What are you seeing on that side of what's, sometimes holding some of these people up on being able to get refinanced?
I would probably say one of the biggest things is just, not having a renter. Now, there is a possibility of putting a person in the property without a renter, but having the rent rolls be where they need to be in order to have a certain, coverage ratio. So let's say hypothetically that the note would be $1,200 and, they're renting it out for $1,100. The coverage ratio doesn't math. Math doesn't math. One of the good things about Northpointe, they will actually go to a negative coverage ratio up to 0.75.
So why would they do that?
I don't know. I don't lend the money. So, I lend the money, but it's not my money. And I think that it's just a statistics game and they understand it. I mean, you're talking, a lot of times in this situation, if you are in a negative coverage ratio and have a loan to value of 75%, they kind of look at it as like, okay, we'll lend you the money. And if that person ever defaulted, they just lost 25%. So more than likely, the bank's still going to be able to take a XYZ property and be able to turn it or sell it and still break even. Okay. Right. So that would be the only reason why. And, a lot of people, and I know investors, they like to spend money sometimes. Yes. And so sometimes with their credit, we're seeing where the credit scores can negatively impact, especially on a DSCR. And what you get is when you start getting below 700 and get below 680, and those scores, that starts limiting your loan to value. And then sometimes it's just one of the biggest issues right now. I think it's kind of leeway into what you're probably wanting, but thought processes of comparing an actual ARV to what an actual appraisal will come into, and having real food for thought, and not basing your ARVs off of, the highest one in the market. Because if you're only doing a halfway, job on the renovation, yet you're pricing it against a full renovation, how do you expect for those values to really come in? And you got to be real sometimes, for sure.
Are you saying, I'm going to step back on one other thing on the 0.75. The only way I could see that too is like, say you go to, say, one of these hot markets, like I'm just going to throw out Oxford, Mississippi right now. They've got they've got an existing tenant in there they're paying $800 a room. So, and they've got 3 bedrooms, so they're only paying $2,400, but they can sell this property for $350,000. Well, they can get those one tenants out there that next year, and then they go up to $1,200 a month per room on it. So I could see where that is just a waiting game, and they're just waiting it out.
Exactly. And that is a super hot market. And
yeah,
I think any college town for that matter seems, especially if you're in the Southeast.
If you're in the Southeast Conference,
yeah, you win.
You win, and you're renting by the room in these places, and they just keep climbing there. But you talk about going into appraisals of where you see that, and we see that too, where we talk to our borrowers of, if you want to get this if you think it's that's what you've got to do. That's what you also have to do. You can't halfway do it and then expect the same result. Yeah.
So that's probably, out of all the DSCR loans, it's probably the number one aspect is, and of course, different appraisers look at things differently. And, when you're looking at the big picture of it, and, an appraisal is a blend of different things, right? It's a blend of reality, which is hard math. This property sold for XYZ. And then it's also somewhat of the appraiser's interpretation on the comps. And it's like, okay, well, this property is a C3. And I'm sure the majority of people that are watching this, hopefully, and I'll explain, C3 is basically the condition. C2 is pretty much a brand new home. C3 is good condition. C4 is needing some serious loving. And C5, I mean, you wouldn't put your mother-in-law there, and maybe some people would, but
they come to us at C4s and 5s,
and you make them pretty and
get them to C2s and 3s.
Yes, exactly. And so, but just because you got a C3, my C3 on a house and that comp C3 may be different, and there's room for difference in those. And so if you went in and hypothetically did just a lipstick on a pig, you're going to get a C3, right? But if I go in there and I put new flooring down, new cabinets, new countertops, and that C3 is going to look completely different, and they're going to put different weight on that, make different adjustments on that. So you have to know really what you're looking at. And I mean, when you're talking about lower valued properties, $15,000 difference is significant.
Yes. And what would you say in those non-qualifying mortgages that you're working in, like that space with what our borrowers are going into, the DSCR loans, what would you say that average ARV, that appraised value is coming back at? Like you're seeing the sweet spot?
Elaborate on what.
Like, so we've got some people that want to, their goal is they want to go buy in a Germantown or a Cairo, and they're and they're going to pay.
Who doesn't, right?
And they're going to pay that, but they're paying $500,000 for this property, but they're only getting $3,800 a month in rent for it.
Yeah.
Versus I will say, like right now, what we've been underwriting all day long, where the numbers just seem to work, is you've got an ARV of $150,000, and you're all into it for between 95 and 110.
Yeah. So I'm going to have to. Yeah, I see what you're saying now. Anywhere in that range where you're able to have a home in a decent area, that 125 to 175 range of overall, I mean, it's tough to beat. Now, don't get me wrong. I mean, I love Germantown and Carterville, but you're just not going to, you're not
going to cash flow.
You're not going to cash flow. And when you start getting above that $300,000 to $400,000 range, and that goes for all of Memphis and a lot of major metropolitan cities, you're just not going to cash flow. I mean, taxes sneak up on you, insurance sneaks up on you, and it's just very difficult. So that's the reason why, I think so many people love our city, love Birmingham and Little Rock, all the different places that you guys touch. Yeah. There's a reason why. So
it's because affordable living. Yes. And we have people from either side of the coast, like either coast, are coming in and investing because it doesn't make sense where they are to own these properties. But here that's like and their mindset is like, I can get a whole property for $150,000. I'm going to be paid. I'd pay $750 for that over there. But they're not getting $75. Some of those people are
paying $150,000 for a parking spot.
Yes. Yes. You get a whole 3-bedroom house here.
Right. Exactly. So,
or in the Birmingham market. And that's where if people look and we tell our borrowers the 1% rule. I know that's kind of an outdated, but that's a pretty easy way to say, like, if you're getting $1,500 a month in rent, probably safe to say we can give it $150,000 ARV as long as the comps support it too.
Right. Yeah. And I mean, that's actually a pretty good rule. Unlike the 1% rule when people say it's time to refinance if it drops 1%. I hate that rule.
Oh, no.
Yeah.
No. And it's like, and it's, I know they've got to be smart too of going into where are there prepayment penalties in these deals? Like look at it to where you're cash flowing now and you're going to be in that loan for the next 5 years.
Yeah. Do you mind if I elaborate on that?
Absolutely. Absolutely not me. Yeah. Elaborate, please.
Actually, please. We'd rather you not talk about this.
Yeah.
So, one of the biggest aspects, when you're looking at a DSCR loan, and I'm sorry, I talk with my hands and, I'm talking in the microphone. And so it's like kind of awkward, but anyways, so when you're looking at a DSCR loan and you have the opportunity and, one of the things I do with my clients is really drill down. What are your long-term goals? Mm-hmm. If you honestly think that you're going to sell this property or you really aren't sure about being in the long-term rental game, then you want to do a short prepayment penalty. Right. Now you're going to pay a higher interest rate on a prepayment when it's shorter. Mm-hmm. Anytime you go from 0 to 2 years, 3 years starts becoming a really nice sweet spot. 5 years, which is a max you can do, is a real big sweet spot. And then I know in certain states, and I apologize not for knowing this information off the top of my head, you can't go past a certain limit. I want to say Mississippi may be 3 years. Prepayment penalty. I may be wrong. We may want to cut that if I am wrong. But
do your research too.
Yeah, no, I'll shoot that information. But so when you're looking at that and people are like, well, I don't know if I want to do it this way. Well, think about it this way. If I was to give you an interest rate of 7.25% on roughly you're financing $110,000, okay, 7.25%, and interest rate starts going back down, right? Mm-hmm. Let's fast forward a year and a half from now. Interest rates have dropped 1%. Okay. Mm-hmm. And now investment properties are at 6.25%. Mm-hmm. The savings on that amount of, roughly, what I say, $110,000 is something like 90 something dollars. That's not going to make sense for you to really refinance that property at that point because of the cost of the refinance and the time to actually get that money back may take you another 3-4 years.
Right.
So, that's the reason I was going about the whole 1% rule. That 1% rule, I like the 1% rule for when it comes to refinance. This is stupid. You have to really just put, pen to paper and get your calculator out. So when you're looking at that, you have to really look at the long term. Like, okay, it's going to take this for it to actually make sense to refinance an investment property. So when you're dealing with those lower figures, something in, 5 figures to low 6 figures, anything I would say lower than $175,000 $200,000, you need to really put the pen to paper, mm-hmm. look at the prepayment penalty and the period of time and what the difference in the interest rate is and do that math. And that's one thing I don't mind doing. Somebody that you actually referred over to the other day, he's like, can you show me 0 through 5? I'm like, yeah, sure. Let's go through it. And at the time we got done, he's like, all right, I'll go with 5. And I'm like, you already knew I knew the answer before the question was asked, but you still have to do that. And that's one of the things we want to be able to walk alongside the client so that they understand, because the better experience that they have with us, and the money that they're able to make, then
they come back.
Yeah. What a novel idea. Right?
Yeah. Well, and it's such a different mentality of a lot of other real estate. You're not focusing on the big hit of like, hey, I'm only going to focus on like 350,000 or better, like us too, of lending or this. It's these people that are doing DSCR, they're usually not just doing one. Right. Their goal is to, I talk to people every day, my goal is to have 300 in the next 2 years. I'm like, I think that's a little aggressive.
I know, it's crazy. Listen to some of these guys and their plans that they have, and you just, sometimes I get off the phone with them and I'm inspired and then just
scared too.
Well, I'm like, are you on something? No, I'm kidding. But no, it's just super impressive to see the mental mindsets in how these guys are scaling that, because scaling is a big deal. And that's where you guys come in.
Yes.
It's such a positive aspect. It's like you're all a one-stop shop.
Yes.
Yeah.
Yeah, so. You can do pretty much everything, and they want to scale. And I hear pretty much every conversation. There are people around our age, middle age now, and
in their 30s. Yeah,
exactly. Yeah, I have kids really young, but they're in this, and they've got kids that are starting to enter high school or starting to enter college, and they're looking at. We lived through the Great Recession, where we saw 401ks just tank, and you've got so many people right now that are around this age. I hear time again, I want to leave a legacy for my kids, or I'm building this for diversity in my retirement. And so that's where their scaling is coming from, is they're looking at where I can't always count on that 401k, but here's another avenue of revenue I can count on.
Yeah.
And so that's why people are, they're trying to scale, because one of these doesn't make sense, but you get 10, it starts to make more sense.
Right. Yeah. It's a multiplication factor that really, makes sense. One, I think sometimes it's probably more of a headache than anything, and then getting up to 10, 5, 10, then you're learning scalability.
Yes.
And then, you get all your stuff and your programs and everything squared away. You have your team,
yes.
You got Crestcore helping find the property, CoreLend doing their lending. I mean, it's
like firm out to you of like, get them out of our
call
loan.
This guy. Yeah, exactly. We'd be besties. So that's just really, having that ability to do all that and having a good understanding it's an amazing process to actually watch.
And they can do it. The ones who follow the process they do it. I mean, I've seen one of our borrowers that's here in the Memphis market that in a year and a half, he's got, I think, close to 30 properties now.
Wow.
And he's brought very little to any closing table.
Yeah.
Because he's buying them right. He's got his team that does the rehab for it. He's in a property safe for maybe 105 to 110,000. And then he's going and getting it appraises for, 160, 170, pulls a little, like basically no money to the table there. And it's just rinse and repeat. We were able to roll origination in. So he's bringing basically his attorney fees to closing costs one time.
Right. I mean, to do that, it's funny. You watch the infomercials and stuff like that, and you see these giant seminars of like stuff like that. You're basically doing and leading people, and they're not having to go to these big seminars. This is basically what those people are trying to sell you, and these thought processes and these ideas at these big old things. You guys are there to help them out and make that happen.
Yes, and we want to underwrite it to where we are thinking of their future 4 years down the road. And I talked to another borrower recently, and you can get a little fearful when we were in a market like this. And it's like, okay, you've got a couple of vacancies now here, and you've got this repair hit. And one of their goals, it was they wanted to cash out a decent amount on the refinancing. But now I'm like, you better sit tight and go ahead and get that rented out, because you're not going to sell it right now, because the rent's $1,550. You owe $168 on the property. You're going to lose 20 grand on every one of these properties. So you've got to look of where this is a long-term, these DSCR, this is not a get rich quick.
No,
scheme.
It's not a Ponzi scheme.
No, it is a slow to the ratio. It's not the tortoise and the hare. You are the tortoise here.
Right.
And moving forward, and don't try to do too much at once.
Right. No, it's slow and steady wins the race.
Yeah. And on that, like for these DSCR loans for doing this, what is it? Liquidity is always thing. What is typically what you want to see on liquidity?
With regards to the property or the actual client themselves?
The client, the borrower.
Really like to see the clients, as far as liquidity wise, they need to pretty much have about 6 to 12 months worth of reserves on the property. Of course, depending on credit score, that could increase or decrease. But 6 months is always going to be, got to have that 6 months. I mean, it's scary to think that like, okay, we're going to lend you XYZ on something that you literally have no skin in the game almost, and then, not have reserves. So we need to have 6 months worth of reserves. And I mean, the majority.
6 months, that sounds like a lot to a lot of people, but that could be $6,000 or 10 grand.
The majority of the time, it's no more than 10 grand is ever needed. Right. So it shouldn't be that bad. And as far as liquidity is concerned, that can be stocks, that can be an IRA, that can be your 401k.
We don't count those, but you can. It
can.
Puts them in a better spot then. Right.
So it's really not that hard, to make that happen. So, so having that little low amount and what we're able to do on our end, very rarely does any issues of liquidity come up, or just a whole lot of credit issues. Pay your bills on time. Yeah.
Yeah. And that's what we tell our borrowers, like, because we get a lot of pushback on like, why do you need to see this or why this? Like, we don't want you to get stuck in our loan because you're going to pay a lot of money for it. And then if we have to foreclose on it, we don't want that. And we're the ones to blame on it. So it's, right. We don't want you to get stuck. So if we're telling you no, it's either we don't like the property because we wouldn't lend, you're going to have an issue getting refinanced out. You might be able to pay this. You've got the liquidity, but you're over leveraged in it. And what we tell people, if you're bringing money towards the purchase price for us, for a hard money loan, then you're overpaying for this property, especially in this market.
Right. Yeah. Making wise financial decisions and realizing, and that's where like, I pride myself, sometimes, right now it's not the time, but having somebody such as yourselves and myself to hold the hands and explain what to expect and to draw out the roadmap that they need in order to have the success that they could be where they want to be a couple years down the road. That's what it's all about, hand holding.
And then you look 2 years down the road, they've done this. They've used me for the hard money. They've used you for the refinance. They could be looking 2-3 years down the road and they're cash flowing 10 grand.
Right.
Of relatively passive income. And nothing about real estate is completely passive. It's still, you've got human beings are involved. So you got to keep an eye on your property, whether that's property management or do this, make sure it stays maintained, keep up on the maintenance, because I'm sure that goes when they go to refinance at that, you're going to take a look at the refinance of what does this property look like now? Right.
No, absolutely. And that's the thing. If people keep their property in decent order, without a lot of defect or neglect, especially on a refinance a couple years later. And sometimes, it just depends on the deal. Sometimes you can get away with no appraisal at that point in time, but very rarely does it happen. So I don't want people to be like, oh, I heard you had the no appraisal, the DSCR loan.
Right. And that is what they will hear.
Right. Oh, no, 100%. Yeah. they hear what they want to hear. So,
because that's what's stuck. Like, oh, no appraisal this next time.
Yeah, exactly.
It's a possibility. Is it probable? No. Possible? Yes.
Right. And you never know. That's the thing. The market is consistently shifting.
It's really hot in here right now.
No, it's very.
A sauna.
Yeah, exactly. I'm sweating all the negativity out. But the DSCR loan is ever evolving, and what is here right now may look completely different. We may have this same talk 12 months from now and be talking about some absolutely new loan program, because they're always changing. The rules are always changing depending on what's going on in the markets and the overall real estate market, because a lot of the money that's coming into DSCR is coming in from different wealth funds. It's coming from hedging and these big funds and everything. And so the appetite is going to depend on always return. If the return is there, they're willing to put more money in to get in, so it's a market shift. So, however, and we end up in a declining real estate market. Like, I don't think we are. I think we may end up with an extremely stable to flat market based upon what I'm seeing overall for appraisals, is that, programs are going to continue to evolve. And, I think, like, I wish I had the know-how, or, I started doing this stuff a couple of years ago. I'd be in so much of a different place and having a better understanding for what I even do in my own job. You know, it's amazing what some of these guys have gone out there and done and leveraged. You know, it's very impressive.
Yeah, and you talk about that for the hedge funds and those of and the coming in, but we've already seen it here too, where we see some, and this goes where you just a few bad apples can ruin a bunch, where you had, and you talked about the type of the C3. This is not the same rehab where some of these people were trying to go where they're comparing appraisals. And so a lender would take those, and then it turns out they didn't do any of this. So it's like we saw a lot of appraisers in these last probably 8 months just tighten back in this market period because you had some basically getting inflated appraisals. And these lenders, they were lending too much money on these properties or cashing them out. And it's not even a rate and terminate. They were trying to they were cashing them out too much. Right.
And you're honestly going to probably see some more tightening on appraisals. There's some new rules and way they. All right, so I'll go ahead and give the whole thing.
Yeah.
So on appraisals, and at least this is for our company, there may be other companies that do it differently, but when you're looking at the appraisals are normally scored, and Fannie and Freddie. So even though we may not be using what they call SSRs on that, there's still a scoring process that occurs on an appraisal, whether or not it's for a conventional type loan or FHA, whatever, compared to a non-QM, which would be DSCR. There's still a scoring thing. And then that scoring model, it says, what is the probability of the value of this being escalated or overvalued? It's looking at, everything that's going on, and, these underwriters, they see this scoring and they see there's different, the more and more AI kicks in and the more data, it's only going to increase. So what it tells is like, well, why didn't you use XYZ comp? Why did you go 0.75 miles away and when there's two other cells that are 0.5 miles away? So that type of stuff. And then what we're also seeing is that on some of these, not with us necessarily, that they are requiring an actual owner-occupied sale compared to just all investors. So, because the majority, and sometimes when these appraisals come in and y'all are selling properties, if you look at certain areas of town and everything, 90% of it could be just rental in that area. And
38127.
Yeah.
Like look at that. That's a prime one. 38109.
Yeah.
Some of those, that's 38114.
Right. And so like if you're doing your valuation on the value, and all you're looking and pulling in is investor sales, you may be doing yourself a disservice in because things are shifting, and especially if the market slows, they could be doing that. So what is happening though, this goes all full circle back to the appraiser though, they're being a little bit more cautious because they're being more and more scrutinized. I think just they're afraid of, a litigious-based society that we live in, being sued and, or have their license called into play. I mean, all it takes is a couple of deals and they could have their license stripped from them.
And that's their livelihood.
Exactly.
And that's what you see. And I know some nationwide DSCR lenders, they would at once, I mean, this was like a kid in a candy store here in Memphis, like they'll go 3 miles in a 3 mile radius to get comps. And I'm like, well, you and I know this city, you can go 3 miles in any direction. You can get whatever comp you want.
Yeah. Exactly.
I mean, you can go 2 blocks and get
whatever. You go 75 to 3 million easily in
a 3 mile radius.
Even from where we're sitting right now.
You are exactly right. Yeah, because we got High Point Terrace right down here. We got Berkeley there, and then we've got
East Memphis, like the heart
right there.
of East, so it's just it's very interesting, and
And then you got North Holmes right there, where it's 105.
Yeah, it's very fun all around here. But it's just very interesting to see the thought processes, and so the times will change. It's just that having the team behind you that is up to date and knows how to navigate you're a captain, I'm a captain. Different. We're sailing different ships, but the overall goal is the same: is to get our passengers to shore or their freight to shore.
And don't be a paying passenger and try to tell the captain how to run the ship.
Exactly. Then you get thrown over or walk the plank.
Well, and it's just because we're trying to protect. You're trying to protect. We're just trying to protect these bars and trying to protect all of these aspects to where this is, as we weather this market that we're in, you should be able to come out much better on the other end.
Right. And I know your personality because we know each other on a personal level from working together over the years and everything. And we're very much the same in the sense that we only treat people the same way that we would want to be treated back. And so when we're doing stuff for people, and sometimes, we have to have the hard conversations with you. It's not because we want to be, because it's what we'd want somebody. We're not trying to move in the shadows and everything. And you want to give the hard information that allows you to make the correct decisions kind of going forward and know the good, the bad, and the ugly. Because, it's not always rainbows and unicorns out there with this.
Yeah. Not every buy is a good buy.
Nope.
And just because, hey, I got this, it's great. No, it's not.
Right. And just like every client is not a good client. I mean, I'm sure you fired clients. I've fired clients. I've had clients fire me because, sometimes the personalities don't match.
They don't. Or it's so this person is like, well, hey, I've got this that's 2 blocks away here. I'm like, but we had an REO that we've had a problem with squatters, and they went inside to grill in the house without power. They brought their charcoal grill inside. So we've seen this, or we know that house 2 doors down is a trap house. Where we know that we know the streets.
Right.
And so, so it's just get your team in place and trust your team. Yeah.
I mean, some of the best people I work in with the whole real estate, they have everything. Title company. You guys use an amazing title company. And, it's just, you got your inspectors and your realtors and your lenders. And when you get everything going, it just runs so much smoother. The whole process is so much more stress-free. And not only that, then we can have conversations back and forth where we're not getting heightened. I've never understood that within the real estate aspect. I don't understand yelling at somebody. It's not like if you yell at me, it doesn't mean I'm going to start working that much harder. I'm just going to probably okay, I hear you, but I lose respect. So it's like, we're all working towards the same goal.
Right.
And at the end of the day, that's all you really have is that we all are working towards the finish line. It's not like one of us is like, you're not sitting back here and I could care less. No, you do care.
Yeah, because we're working to get you, our finish line for us is to get you into the loan, into the DSCR loan, and get you out of our loan.
Right.
Without having to jump from our regular interest rate of 12%, which is so affordable, into where if you go past that 6 months, then you're going up to 18%. We want to get you out before then. Like ours is, if we can get you out of here in 3 months, great. You've saved 3 interest payments, and now you're in your DSCR loan.
Right.
We'd just rather have that, and then you're like happy as a clam and come back and do another deal with us.
Exactly. Yeah. Eat, sleep, repeat.
Yes.
Yeah. So,
yes.
For sure. I almost forgot how that saying went. I don't know why. It's just one of those moments like, all right, brain work. Yeah.
Okay. Well, Ryan, I appreciate having you on today. Yeah. Anything else you would like to talk about with Northpointe?
No, it's just the greatest company that I've worked with in 21 years as far as a bank, and just super thrilled to, work for them. And they are publicly traded on the NASDAQ. So they're a big company with deep pockets, which makes it a big deal. And they listen to what I've already brought to them. I've already asked for some changes with regards to DSCR, and we're working through that. And, I'm excited that there's actually a big enough bank like that it actually has an open door policy that if we need to make some changes, let's talk about it.
And if we're making it work in a market like this, and these things really make sense, it's like, how much are you going to win? And how much is that bank going to win in other areas?
Right. And then go and hopefully possibly teach other loan officers on how to go into other areas and meet up with great companies such as yourself. So, yeah.
I appreciate that. Yeah. Well, everyone, thank you for tuning in, and we will see you next time.
All right.